Turning to the UK outlook, as well as their impact on financial markets, Brexit developments are making UK GDP growth more volatile than usual, owing to stock building and auto plant shutdowns. Looking through these temporary factors, the underlying pace of growth has slowed to below potential rates as a result of weaker global demand and more entrenched uncertainty about Brexit amongst UK companies. Only 1 in 6 respondents to the bank's decision-maker panel now expects the future relationship with the EU to be resolved this year, down from almost half in January. 1/3 of our agents' business contacts report being more uncertain about the economic outlook now than they were ahead of the extension of Article 50 in April, while only 1 in 10 have become more certain. These developments have already led to marked weakness in UK business investment since the referendum. Investment intentions point to further contractions in the second quarter and third quarter of this year, and the MPC now expects business investment to pick up more slowly over the course of the next year. By contrast, the labor market remains tight, with employment at record highs and unemployment at 44-year lows, and pay growth strengthening as a result. Supported by the resilient labor market, households' confidence in their personal financial conditions is holding up, with spending rising broadly in line with real incomes. No debt-fueled consumption boom, and households' concern about the general economic situation continue to restrain housing market activity. Overall, the MPC expects underlying GDP growth to remain subdued over the course of the coming year, with Brexit-related uncertainties and softer external environment both weighing on spending. Looking forward, increased uncertainty about the outlook suggests that the UK economy could follow a wide range of paths over coming years, depending, most importantly, of course, on the nature of EU withdrawal. Consider, as financial markets increasingly have, the prospects for no deal. The bank has been working since the referendum to ensure that the financial system is ready for Brexit, whatever form it takes. But financial stability is not the same as market stability. In the event of no deal, no transition Brexit, sterling would likely fall, the risk premiums on UK assets would rise, and volatility would spike higher. Similarly, preparations by governments and businesses for no deal are vital to reduce the potentially damaging transition costs to a WTO relationship with the EU. But those preparations cannot eliminate the fundamental economic adjustments to a new trading relationship that a no-deal Brexit would entail. In the event of no deal, it's probable that CPI inflation would rise and GDP growth would slow. For example, our agent surveys of businesses finds that most companies now report that they're largely ready for no deal. However, just a fifth describe themselves as fully ready, while 3/4 of respondents say they were, I quote, as ready as they can be. And despite greater preparedness, businesses still expect their output, employment, and investment to fall by about 1 to 3% over the next year in the event of no deal.